Hello, anyone who is on the line. Welcome to our Coffee and Conversations. We are still about 2 minutes away from getting started. Share my screen. Share. Oops. Everyone can enjoy this wonderful view of our bridge, our contact information. And we will get started in a couple minutes. Well, not a couple minutes, excuse me. Hope everyone is having a great week and weathering any more Easter effects they may be getting. I up here in New York in 25 degrees under about 5 inches of snow. So shoveling this morning was interesting. Okay. So I would like to welcome everyone to our Coffee and Conversations here in March for our financially taboo topics is our theme this year. Nothing taboo about talking about your portfolio, but after a year like we had last year with plenty of volatility, it may not be the easiest thing to turn and look at your portfolio, see the account values changing, going up and down. But things are developing and looking better. And today, to help us expand on that topic, we have a privileged guest. We have Whalen from Thornburg Investment Management with us today. Hal, thank you for joining us. Hal is a senior consultant with Thornburg, and he joined Thornburg, I think 9 years ago, was it?
No, it was actually 3 years ago.
Oh, 3 years ago. Excuse me, I misread my own data. Prior to Thornburg, Hal held vice president and regional director positions with Natixis Investment Managers and Eaton Vance. Two other excellent investment shops we've currently used and have used in the past. And way back when Hal got his Bachelor of Arts in Economics up in the beautiful Green Mountains at the University of Vermont. So Hal, you and I have that in common. We have a BA in economics. So
I'm
so
happy.
Hal,
I'm happy I'm not there today with all the snow they've been getting.
They're probably reeling from this storm. And before we get started, everyone attending today, please, we would love to hear your questions. So at the bottom of your Zoom window, there's a little icon that says Q&A. Just click into that, and whenever you have a question, type in your question. You can direct it to me, and we will work those in as they're asked, and certainly leave time at the end for any questions we haven't gotten to along the way. So Hal, I'll get us started. And we're just going to start with something that's really forefront in everyone's mind. You know, it's inescapable over the weekend, the big, huge action and collapse of the Silicon Valley Bank. And I doubt anyone on this line had money with Silicon Valley Bank, but it raised a lot of questions about the banking system. And, you know, Thursday and Friday were very volatile there. And, you know, the government stepped in over the weekend. I myself was doing a lot of reading, and then Monday doing even more reading. I got a very up close look at the plumbing of the entire banking system. And no one really cares about all that, but at the end of the day, they just want to know, all right, does the toilet work? And for our clients, I think at the end of the day, they just want to know, you know, are my deposits safe? So the government stepped in, tried to reassure all that. Other big banks, and you heard other institutions like Charles Schwab stepping in to reassure all their depositors. So we're just interested, you know, Thornburg, I'll warm you up a little bit. Thornburg does research on the equity side and the fixed income, the bond investing side. So you guys do credit research on these issuers as well as equity, you know, due diligence style research. So we'd love to hear if Thornburg has any comments on this, and maybe was there a larger lesson to be learned from this big episode that unfolded the last couple of days, and will there possibly be any lasting effects from it?
Yeah, no, and I appreciate the question. It's obviously the situation is unfolding kind of as we speak. And I think the message that we wanted to convey, had a number of conversations yesterday with folks like yourself, like you, Joe, and Elina, about bigger implications. And I think the biggest risk, especially over the weekend, was this notion of contagion. That it obviously it started with two banks that were very specialized. I think that's one of the things that we wanted to communicate. Silicon Valley Bank was not a normal bank by any stretch of the imagination. They really catered towards the startup industry and the venture capital world. And what we have noticed and what we've been experiencing over the past really 12 months or so, with interest rates rising pretty dramatically, less money, there was less money kind of sloshing around the venture capital space. So, a very specialized bank like Silicon Valley Bank was in a very different position than virtually all other banks in the United States, in that there was less money coming in from venture capital startup investments, and they had more money going out the door. So their deposit base was shrinking for the first 3 months of this year. And I think from our perspective, it's not the health of the banking system. We think that banks in the United States are in really good shape right now. This is not 2008. I think that we think that the regulations that have been put in place over the past 15 years have led to much better behavior. So banks can no longer take excessive risks with your deposits by what we call proprietary trading, essentially gambling with your money on risky investments. That is really not part of the banking system anymore today than it was really prevalent in 2006, 2007, which led to the financial crisis. The risk on Friday was, unfortunately, I don't think, and I don't want this to be, this is not a doomsday scenario. There are very few banks in the United States that can handle 25% of their deposit base leaving in one day. And that's what essentially happened at Silicon Valley Bank. I believe that it was a rate of $4.1 billion an hour on Friday on about a $200 billion asset base. And my wife works for a company based in San Francisco, and they were part of the problem. They pulled all of their money out of SVB on Friday, which kind of led to this a classic bank run.
Yeah.
And it expanded to Signature Bank, which we think was our opinion, absurd. Very different situation for Signature Bank, but we saw the government basically step in and create facilities for banks to access liquidity to shore up their balance sheets. And it was sort of a knee-jerk reaction to ring fence the situation, to make sure that this fear didn't spread to other banks. And I was talking about this with somebody internally that on Monday, we are not day traders. We are long-term investors of our shareholders' money here at Thornburg.
Yep.
But if we had been day traders, buying something like a regional bank index on Monday was probably a really good opportunity, because we think that a lot of those fears they tend to get overblown over the short term and then tend to work themselves out over longer periods of time.
Yeah.
And we had thought that fear was really overblown, especially on Monday, coming out of the weekend, when it seemed like news was bouncing around and there was something new every couple of minutes about what the federal government was going to do. And what they did do was essentially say, we're going to backstop the banking system if we need to, which we don't think they need to, quite frankly. But it was just a bit of a reassurance saying, don't worry, depositors, you don't have to worry. Please do not go and run to the bank and take all of your money out, because at the end of the day, you will be made whole if it actually comes to it, which we don't think it's going to come to that because of the health of banks in the United States.
Thank you, Hal. That was very informative and very colorful for our clients. And as somebody actually who did spend the last decade working in investment management at a financial institution at a bank, I echo many of the observations that you just shared. So Joe touched on how 2022 was a bit volatile, and now we're near the end of the first quarter of 2023, and we have another 3 quarters remaining. So taking a step back from just the banking sector, more broadly speaking, as an investment manager, as an economist, what's your outlook for the remainder of the year, both in investments and the broader economy?
Yeah, great question, and thanks for that, Elina. So we're cautiously optimistic. That may seem like a bit of a cop-out, kind of playing both sides of the fence. But the reasons for our optimism, I think, are rooted in a lot of what happened in 2022, which admittedly was a very difficult year, especially for investors that were diversified across stocks and bonds. And we don't typically experience years like 2022. Historically, when we start to see, call it an earnings slowdown, where companies are earning less money in a given year and our growth starts to slow, historically, things like fixed income offer protection or insurance at the portfolio level. But last year also coincided with Chairman Powell and the Federal Reserve essentially doing everything but yelling from a bullhorn and telling us that they were gonna raise interest rates and be very aggressive about it. And you normally don't see that dynamic. Historically, when we start to see growth slow, interest rates, they tend to use interest rates as a tool to stimulate growth and increase liquidity in the marketplace. And that was the complete opposite. We haven't seen this since, I believe, the 1970s was the last time we saw the central bank in the United States raise interest rates into slowing growth. And I think the 800-pound gorilla in the room, which was pretty uncomfortable inflation last year. So, what we want to caution people is that last year was an abnormal year. What we are optimistic about is I think a direct result of the Federal Reserve raising interest rates. For the past 15 years, we've been living in what we would call an incredibly abnormal environment, where interest rates were held artificially low for really a 15-year period. And for us, we think that encourages excessive risk taking, bad behavior. When companies don't have to, when companies can borrow at extremely low rates, they don't have to worry about being good stewards of capital, really being profitable. And we are going through what we call an interest rate normalization process, where rates today are far closer to the normal average than they were for 15 years. And we think a couple of things. One, fixed income is finally going to provide value at the portfolio level for the first time in 15 years. And so, this notion of diversification being dead, we think is completely overblown. And that going forward, when you buy a bond or when you buy a bond fund, there is actually a substantial income component. I think we've been saying that there's actually income in fixed income for the first time in 15 years. So we're optimistic that not only these processes are painful to work through, and we experienced a lot of that pain in 2022, but we think we're going to be getting back towards a more normal environment where you're going to see better behavior out of companies because they actually have to earn money to pay back and service their debt obligations. And clients are going to have the opportunity to invest in fixed income that will deliver attractive returns for the first time in quite some time.
Wonderful. Yeah, I was going to ask you about bonds. I think I heard the stat bonds had their worst year in like 90 years or something like that. Certainly since the current version of the bond index has been out since the 70s, this was by far the worst year. So that was good to see. How about what is Thornburg's opinion on cash? You very well articulated that bonds now provide income, and it's that diversification from as an equity. Diversification to equity risks. What is Thornburg thinking about cash right now? What role does that fit in a client's portfolio?
Yeah, so I guess I would answer this I'll answer it from two different lenses. I guess I'll answer it through the lens of the attractiveness of actually owning cash right now, and then through the lens of how we think about it in terms of managing client portfolios. So I think sometimes the simplest investment can be the best investment for a period of time. And I think we're in one of those periods right now, where, a year ago, if you bought a 1 year treasury bill, you bought it 3-4 months ago and you held it for a year, you were essentially locking in a guaranteed 5+% return, which again, we haven't experienced that for 15-20 years. But we can see it, but that tends to change and change quickly. And we've seen that really over the past 3 days since all of the volatility associated with fears around the banking system arose last Friday, where we saw roughly a 1% move in a short amount of time in the interest rate that you were getting off of those cash and cash-like instruments that you could buy in portfolios. So I think that for a period of time, it makes a heck of a lot of sense. But once we start to see stabilization from the Federal Reserve, and actually if we start to see rates start to come down a little bit, then all of that cash is going to be looking for a home, because there will be more attractive opportunities in fixed income and overall, and we're seeing that at the portfolio level. Not to get too technical, but at the portfolio level, we are in our various mutual funds and separately managed accounts, we're holding more cash as well in portfolios than we normally do. First of all, because you can actually get a return on those investments for the first time in quite a while. But second, I've mentioned sort of cautious optimism and kind of this process that we're working through right now. Call it a financial normalization process, going from the lowest interest rates we've seen in a long time to normal interest rates, that you tend to get a little bit more volatility in those environments. And volatility for us creates opportunity. I know sometimes that can be painful to watch, portfolio values kind of bounce around, but those are opportunities that we find exciting, because you don't see that rising tide lifting all boats where everything kind of goes up in unison. It creates more opportunities for us to take that cash off of the sidelines and invest in high quality companies or fixed income investments that are trading at discounts to what we would normally see.
Yeah, we've heard other managers refer to it as the proverbial dry powder. So
exactly.
So we talked about cash, talked about fixed income. What about you talk a little bit more about two things, so equities and investments abroad. I think especially with internationals, there's concern, obviously, with the 1 year anniversary of Ukraine-Russia war, escalating tension in China, and just continued international ripple effects from COVID. So where do you stand? Where do you see the risks and where are the opportunities?
Yeah, so I think that we are more optimistic about opportunities overseas today than we have been for 15 years. And it might help take a step back and obviously talk about why that is. And a lot of it's driven by, I think, a major theme that we've been talking about for the past 20 minutes or so, and that's interest rates. If you think about U.S. markets and U.S. companies, we tend to be very growth heavy here in the United States. And when interest rates are really low, that tends to favor outperformance from growth type businesses. Now we discussed a couple of minutes ago about this, about higher interest rates, and that tends to favor companies that generate a lot of cash today, as opposed to a growth company which is hoping to generate cash 5 to 7 years down the road. And if you think about international markets, in particular European companies, they tend to be those what we call those cash generative companies, sort of cash cows. They might be boring companies that export things to the United States or the emerging market space, but they generate a lot of cash today. They grow a little bit each year. A lot of them pay dividends that may grow a little bit each year. But really, for the past 14 years, nobody has really wanted to talk about those types of businesses. Everybody wanted to talk about, what's the next unicorn business here in the United States that can deliver food to my door in 10 minutes instead of 15 minutes. And that really, in a higher interest rate environment, those companies have a really difficult time being profitable year over year over year. Whereas, those businesses that are cash generative do far better in an environment such as what we're entering into right now. And it's funny, I was looking at this earlier today, that this conversation, I think, would have been entirely different 15 years ago. In 2007, I think people would have been saying, why do we need to own any US-based companies? Because we had just been through a 7-year period where international stocks far outperformed US stocks. And a lot of that tends to coincide with these interest rate cycles, specifically US interest rate cycles. The last time international stocks outperformed for a long period of time was the last time we really raised interest rates meaningfully here in the US, and that was from 2002 to 2007, basically. So I think part of it is the environment. And the second piece is a lot of the issues that we're dealing with here in the United States. Europe did a far better job dealing with things like inflation. Even though their overall inflation number is higher than it is here in the United States, a lot of that, roughly 2/3, has just been driven by energy costs, which is a direct result of the Russia-Ukraine war. Energy costs have come down substantially. They did some different things around COVID that we didn't do here in the United States. They furloughed workers at a much lower pay level than we did here in the United States, essentially increasing unemployment insurance, so paying people more money to stay at home for an indeterminate amount of time. So when you look at some of the issues that we're dealing with here in the United States, the big one being inflation, they've got a far more manageable environment than we do here in the United States. And I think the last piece you asked about was China as well, China and Taiwan tensions. As a firm, I think China probably looked at what's going on. We think China looked at what's going on between Russia and Ukraine and the issues that Russia has had, and thinks that we think that we are far away from a scenario like that happening between China and Taiwan. And I think a case for why China may not be it may be kind of a taboo subject from an investment standpoint, but it's an area that we think represents a significant engine for global growth. They tend to have the Chinese population tends to have very high household savings rates. And there's a tremendous amount of pent-up demand as a result of Chinese citizens being essentially locked in their houses for 3 years. And then, everything reversing course the first week of December. So we expect very attractive growth opportunities in Chinese markets. And I think, one last thing I'd add is that investing, from our perspective, investing with geopolitical risks at the forefront is incredibly difficult. You can't predict. I think a little over a year ago, very few of us had thought that Russia was actually going to invade Ukraine. So it's difficult to predict these things in the future. And somebody much smarter than me at one of my prior firms had said, look, every year I think I could wake up on January 1st and create a list of 10 really good ideas about why I shouldn't invest in X, Y, or Z, in this case, international equities. But over the past 20 years, you would have missed out on very strong returns simply because you had a negative view on the geopolitical situation or various issues. And I think that can be incredibly difficult to get those things right, all the while missing out on attractive return opportunities outside of US markets.
Yeah, wow, very good answer. I heard you say in there that some of the good, attractive investments can be boring. It sounds like a very Warren Buffett thing to say. So
well, boring can be good. Boring can be very good.
Exactly. Yeah. So we heard you say you guys are excited about the opportunities in international. I understand all those things related to China, because we've seen that since back into the 90s. China really started to become this engine that fueled a lot of the growth around the world. And that's definitely still the case. What are some other opportunities Thornburg's seeing? Maybe a couple specific examples. Is it, pockets here and there? And I imagine last year, many of our clients used a strategic income fund. Those managers must have been going nuts last year with all the price dislocations in bonds. Are they liking high yield? Are they liking bonds issued by Apple. Thoughts on emerging markets? Is it US small caps getting juicy yet? What is Thornburg getting excited about?
Yeah, so I think two things. One, we are very excited about emerging markets. It has been an asset class that has been, call it, run through the ringer over the past couple of years, and a lot of that has been driven by China. China is, if you look at the composition of emerging market countries, at the index level, they break it up by how big a country is relative to the overall index. And China represents almost a third of the emerging market index, roughly 32% of the underlying composition. So we had, if you think back to the last couple of years, we had obviously COVID hit, and in 2021, China's central government went on call it a regulatory purge. So they have obviously a much different, I think, stating the obvious, a much different style of government in China than we have in the United States, and it's much easier to regulate companies into oblivion if they get on the wrong side of the CCP.
Yeah.
So we saw that essentially a crackdown on the technology space in China in 2021, which led to basically a 25% negative drawdown in Chinese equities. And if you think about a third of the underlying index coming down 25%, we thought going into 2022, with the abatement of some regulatory pressures, probably a pretty attractive place to start thinking about reinvesting. What we didn't foresee, and again, this is part of the difficulty of investing from a geopolitical perspective, was China's adherence to a zero COVID policy throughout much of 2022, which led to another 25% drawdown in Chinese equity. But as we stand now, I think part of the reason why we are so excited about the emerging market space is not only that drawdown has led to very attractive prices that we can find for companies based in the emerging market space, but I think the bigger piece is they have a much different demographic picture than we have in the developed world. US and the developed space in Europe, low birth rates, aging population base, it becomes very difficult to stimulate growth. Whereas if you look at emerging market countries, something like 68, as we stand today, 68% of the world's middle class lives in an emerging market country.
Wow.
And by 2030, that number is expected to be almost 80%. And emerging markets today are not the emerging markets of 15, 20 years ago, where a lot of people, I think, still assimilate emerging market countries as sort of these commodity-based countries where they export rare earth minerals or oil and gas, or manufacturing hubs, which, don't get me wrong, they still do a tremendous amount of manufacturing, but they really have changed over the past 10, 15 years to closely mirror Western economies, where most of the growth is driven by consumption, people buying goods and services based. And really, a lot of that consumption tends to be driven by the middle class. If you think about it, when people arrive in the middle class, they tend to, their spending behavior, their spending habits change pretty dramatically. They buy smartphones, TVs, nicer cars, spend more money on healthcare, certain things like that. And that has been a huge engine for growth in the developing world for the previous 50 years that we think is just starting in the emerging market space. So that's one area that we are incredibly excited about, because those demographic trends tend to be really powerful drivers for growth and for stock performance over longer periods of time. And you had mentioned strategic income before. I think I'd be remiss in not mentioning just the broad opportunity in fixed income in particular, but more specifically, as we go through these periods of volatility here, specifically here in the United States that we really experienced last year, you tend to get a lot more opportunity. You get prices that dislocate. So things are valued at X when they should be valued much higher. And we're seeing a lot more of that in fixed income markets because of what the Federal Reserve is doing. The raising interest rates has created more volatility for us to actually buy bonds that prior to 2022 were trading at a premium. And what I mean by that is, you buy a bond that's valued at $100. and you wake up, 6 months later and it's valued at $110. That's not a great investment opportunity. We like it much more when somebody buys a bond at $100 and they have to sell it, but they sell it at 90 cents in the dollar. Those are environments that are much more advantageous for us to demonstrate value and provide stronger sources of return to our shareholders. And that's what we're starting to see more and more now as a result of this interest rate policy that we've been going through over the past roughly 12 months.
Super. Yeah, and I want to remind clients, there is a Q&A function at the bottom of your window. So if you guys have any questions at all, please let us know, and we'll do our best to answer them. Elina, go ahead.
Thanks. So Hal, so we want to essentially put it all together. And earlier you said, you're not a stock picker, you're a portfolio manager. And similarly, we're not stock pickers, we're asset allocators for our clients. And we do this, of course, right, to keep our clients well diversified, really, so we limit the downside risk, and we also leave open the opportunity for upside risk on things that are very difficult to predict. So along those lines, we would love to hear from you and get a good understanding about how you and Thornburg really frame that asset allocation discussion with your clients, especially given the experience of 2022. So looking a little bit backward and then thinking about 2023, looking forward.
Yeah. And I think this is an incredibly important question. And part of it gets into just simple human behavior.
Yeah.
We spend a lot of time talking about this notion of recency bias, which tends to be incredibly powerful. And what I mean by that is that, there tends to be, human behavior tends to gravitate towards what's worked for the past few years is the only thing that's going to work in the future. And it's an incredibly powerful emotion, and it's very hard to overcome some of those instincts and some of those behavioral biases. And really, for I keep on at the risk of harping on it, discussing how the past 14, 15 years has been incredibly abnormal, and what we are entering into now is a much more normal environment, from an interest rate perspective, from the perspective of fixed income offering very attractive returns, the possibility of very attractive returns for the first time in quite some time. In this notion that I think at the end of the day, the benefits of diversification are, let's build something where you have specific pieces to this puzzle or to the pie that aren't going to all act the same at the same time. And at the end of the day, I think, to me, that's the most important part of diversification, is that you have different sources of returns baked into a portfolio that are going to do different things at different times. The last thing you want is to go through an extended period of volatility and have your entire portfolio behave identically, because that provides an incredibly difficult experience. And it leads to more of a human behavioral biases coming into play, essentially fear and greed. When everything is going really well, there's this nature of wanting to have more of what's done well, and when things do poorly, you want to avoid those things. So having a well-diversified portfolio, it's worked for 40, 50 years, and just because it didn't work because of the really abnormal environment that we went through last year, doesn't mean that it won't work going forward. We are huge believers in asset allocation and diversification, because we think that's exactly what it's intended to do, is provide more consistency of outcomes over time and avoid those really poor years, those really negative years, when those behavioral biases kind of kick in and you have that fight or flight mentality where you just want to sell and go away. And that tends to be disastrous over longer periods of time. That missing out on selling at the bottom and missing out on the inevitable rebound, it tends to really set people back from a financial planning standpoint, from a return generation standpoint. And I think that's the whole goal of diversification, is really keep people invested over longer periods of time, deliver more consistency of outcomes, so you don't have those outlier years where things are all negative at the same time, by being over leveraged to a single asset class, a single solution, a single style. And that's why we've always been big believers in diversification and asset allocation.
Couldn't have said it better myself. Oh, that was an excellent answer. Thank you. We do have a question from a very astute audience member. They're saying that the Fed is continuing to raise interest rates with the primary goal of keeping inflation in check. You know, that's the reason they've raised as aggressively as they have, because how high inflation was. That inflation is fueled by consumer activity a lot. How does that consumer activity that's kept inflation strong not resulting in good growth numbers?
Great question. So I think part of it gets into productivity gains in the marketplace. Essentially, how much does each worker in the United States produce? Part of it, I think, is driven by technological gains. That if you see the rise of technology over the past 15 years, that productivity growth has slowed somewhat over the past 15 years or so, as we've become more reliant on, call it the gig economy or automation, specifically here in the United States. Look, I think that you know, when you look at inflation here in the United States, a bigger portion of that right now is actually being driven by services and not goods. And what I mean by that, and I think it's probably part of a bigger discussion about what is the natural rate of inflation here in the United States, and if it's not 2%, what is that? You know, our opinion is inflation is probably not going to be down to 2% anytime in the near future, just because you know, the three main components to core inflation are housing and shelter, goods, and services. And services is essentially wages. And what we've experienced over the past year has been pretty incredible from a wage growth perspective. For the past 30 years, wages grew on average roughly 3% in a given year. And in 2022, it was up over 6.5%. And that tends to be really, really sticky. You can't offer somebody a job at a certain level of compensation, and then a year later kind of pull the rug out from underneath them and say, "Wait, I'm glad we got you in the seat, but we're going to pay you 25% less today than we did a year ago." And we've got an incredibly tight labor market, 3.5% inflation here in the United States right now. So this notion that, you know, we're going to get back down to 2% at any point in the near future, we just don't see how the math really works out to get back down there. Now, 3.5% inflation is, in our opinion, not disastrous. I mean, you look at how our country grew, you know, from the 80s through 2009. We had higher interest rates. Inflation was higher than 2% for the majority of that period. Granted, at the front end of that, it was really high coming out of the 70s. But people still had jobs, people still spent money, and our economy still grew pretty impressively over that roughly 30-year period. So I think that it's a difficult question to answer, just in the sense that, you know, it's not a linear relationship between people buying, you know, TVs and buying goods being directly correlated to growth and inflation. But our belief is that, you know, part of the reason why growth is slowed from a historical perspective is some of that, some of the lack of productivity gains, some of the rise in technology, and this notion that inflation is probably going to be higher over the next couple of years than we've been accustomed to for quite some time. I don't know if that fully answers the question, but
that was a very comprehensive angle on it. Yeah, thank you. And I'll take a quick stab at answering that for our client as well. I think it actually did lead to strong numbers. That's why inflation has persisted. And that, I mean, looking at market observations, that may have been a big contributing reason to why the market was so strong in January. You had all these retail companies coming out reporting better than expected numbers. You know, Walmart, Target, all beat expectations. And those are the big hubs for consumer activity largely. So you were seeing good numbers flow through in the businesses from those consumers still being active. But in the same call, they reported those good earnings. All those CEOs were saying, we don't expect this to continue. Things are going to slow down. Everyone temper their expectations. And that's something we've talked about on recent videos. I think Elina's gonna lead us out with one last question, unless any clients want to chime in with anything left on their mind.
So Joe, I see one question from Cecily Holt here.
Yeah.
about Credit Suisse.
Oh, yes, thank you.
On my end. I mean, I guess I'll start off by saying I'm really glad to be where I am here at Thornburg today than at my prior firm, because we had one portfolio manager in particular who had been a huge fan of European banks and Credit Suisse in particular for quite some time. So I think that we are. Credit Suisse is a very different, they've had to deal with a lot of things that U.S. banks haven't had to deal with over the past couple of years. And I don't know, am I echoing? I just want to make sure that I'm coming through clearly.
Not echoing, but we hear some
Okay.
background chat.
Okay.
We can hear you pretty clearly.
Okay. Yeah. So I guess what I would say is that the concern about we have concerns about Credit Suisse as an individual company. But not as part of a larger systemic risk, because Credit Suisse has dealt with a whole host of issues over the past 5 years that U.S. banks haven't had to deal with. Part of it, negative interest rates in Europe were very difficult for European banks to be profitable. A lot of what retail banks do is make money on what they call net interest margin. They essentially take your money, keep it in an account and pay you a small interest rate on it and then lend it out at much higher rates. But when interest rates are negative, that interest margin becomes very, very difficult to generate profitability. I think the bigger concern for us as it relates to Credit Suisse is they engaged in some pretty bad behavior and some excessive risk taking. There were a couple of things in particular over the past 2 years that caused them to experience, I believe it was almost 20 billion with a B in write-downs as a result of poor risk management. Part of it was a hedge fund that blew up, Archegos Capital, that blew up 2 years ago, and then another company called Greensill Capital Management, which was a very specialized lender that had a massive line of credit with Credit Suisse that went bankrupt, and they essentially had to write down the entire value of those lines of credit that they were offering to those two companies in particular. I think Greensill represented a $10 billion loss to the company, and the hedge fund Archegos Capital, I believe, was almost 10 billion. These are situations that U.S. banks have not had to deal with. Much better risk controls in place. Much less risky behavior out of the major banks here in the United States. So I wouldn't want to own Credit Suisse personally, but it's not something that we are concerned about creating contagion or a ripple effect in the U.S. banking system.
Yeah, thank you. I think contrasting those risk and the active risk taking by that one company versus a systemic problem is very important to point out. Thank you for pointing that out. Well, folks, we've reached our time. Couple very good questions. Thank you for asking. If anyone has any questions that they didn't get to answer or that they think of later, please shoot us an email or pick up the phone, call your advisor. We're happy to get you the answers you want. Hal, I want to say a very big thank you to you for coming out and lending your experience and the brain trust over at Thornburg, what they're seeing these days. And I want to mention to everyone, we go onto our website and click on our Insights tab, and we have a lot of our videos that talk about these things that we've been discussing here that you can go and watch at your leisure. So sorry, go ahead.
I was just going to say, it was my pleasure. I really appreciate you and Elina having me on today and giving me this opportunity.
Yep, it was a privilege. Thank you for joining us. And everyone be on the lookout for our next Conversation Conversations coming soon. And we will see everyone later. Take care.